This is a conversation I wish I never had to talk about. Two major US banks, the Silicon Valley Bank and the Signature Bank, collapsed last week. While many Americans are scared of living paycheck to paycheck right now, most are now worried and wondering whether their savings at the banks are safe. Their saving deposits are safe at their banks. But the good news is that with the 5 lessons that you will discover in this episode of the show, you will be well equipped to prepare for unexpected. Hello, powerful people. Welcome to the More Money with Millen, a show that is kind of operating manual for creating your best rich life. I'm Millen Lewis, holistic financial independence mentor. I help people become financially savvy and have more money with less risk and less stress. Now, if you were fortunate to save money, maybe for your retirement or even before you retire, if you have savings, and you want to invest your money strategically so it grows and works for you, like my money works for me right now, I'm going to gift you my beginner investor toolkit that has 8 simple steps that you can take to become a strategic investor and make your money work for you. So you can go to giftfrommillen.com to download this very, very powerful and practical guide, how you can invest your money strategically. All right, so let's start our topic today, which is very, very important for many Americans right now. So as I said earlier, 2 major regional banks, US banks, the Silicon Valley and Bank in California, and the Signature Bank in New York, collapsed last week, right? Silicon Valley Bank, often referred to SVB, I will use this term as well. This bank was considered by many tech startups and investment firms as the reliable banking partner. The bank was known, this bank, SVB Bank, was known for betting on startups that no other banks would touch. Interesting, right? Some tech startup founders and workers at the startups had gotten their first business loans and even home mortgages and car loans from this bank. Many venture capitalists, known famous venture capitalists, set up their accounts at Silicon Valley Bank back in the 80s when the tech industry boom started. So what happened? What happened? How could this established bank with its pristine reputation collapse? After all, like I said, many famous venture capitalists, I don't want to use the names here, but many famous venture capitalists that I'm sure you know the names, and multi-millionaires, famous personalities had their portfolio startup companies banking there. Because these venture capitalists, they have portfolios of companies, right? And they recommended these startups to bank at this bank. So there were several reasons for the fiasco with this bank, right? Like it's usually more than one reason, right? And what is interesting to me is that the main cause of SVB failure was not even risky cryptocurrencies or investing in cryptocurrencies or some elaborate financial schemes. I will share with you my opinion, right? So in my opinion, some of the main causes of this bank's failure were a series of bad tactical and ill-informed strategic decisions. In short, staggering incompetence of the bank's management. Staggering. As you know, 2021 was a year of booming stock market, fueled by record low interest rates. Cost of money was so cheap that numerous tech startups were popping up like mushrooms during the good rain season. So the SVB was taking cash deposits from its tech startup customers and was investing this money into various long-term, low-yielding treasury bonds that were purchased before interest rates began to spike in 2022. Okay, so they purchased them before. At the time, those investments probably looked safe because interest rates were historically low. However, these investments became increasingly risky once interest rates rose into 2022 and the treasury bonds lost their value because bonds prices go down when interest rates go up. So SVB banking geniuses should have known that out of control government spending and constant money printing will lead to high inflation, and high inflation will crash bonds prices, right? They're professionals. And since the cost of capital became more expensive with high inflation, many tech startups needed to pull their cash deposits out of the bank to pay for the expenses. And what happened? The SVB had to sell some of its bonds at a loss to meet its obligations. But there is more to this story. Like every story has two sides to the story and one side of facts. While SVB was a relatively small regional bank, it's the 16th largest bank in the country. Not small, but relatively small, right? It's fair to say that it had a preferred bank reputation in tech community of the Silicon Valley because of its risk-off attitude toward its operation. I mentioned earlier, right, how they were lending money to startups that nobody else will touch. So here's what I mean when I say risk-off attitude. Out of Silicon Valley Bank's 173 billion in deposits, a little bit more than that. Out of 173 billion in deposits, only 21.7 billion was insured. Okay? In other words, over 87% of SVB customers who deposited their money into this bank were risking not getting their money back. Okay? Apparently, regional banks have looser bank solvency requirement than bigger national banks. Anyhow, the SVB customers and investors panicked, right? I'm telling you the story before I will share with you the lessons. So customers and investors panicked, and bank shares plunged more than 60% last Thursday, and then another 60% on Friday. And then banking regulators stepped in and took over SVB Bank. Then on last Sunday, another bank was taken over by Fed regulators, bank regulators, Signature Bank in New York. Now, I believe yesterday, Moody, which is credit rating firm, right? They rate companies' solvency, companies' financial credit solvency. They cut its outlook for the entire U.S. banking sector and placed 6 U.S. banks on review for potential credit rating downgrades in the wake of Silicon Valley Bank collapse. Moody warns all the consumers that more banks may come under pressure after this SVB Bank failure, particularly those with large amounts of uninsured deposits and long-term treasury bonds that have crumbled in value for the reason that I explained earlier, right? So not only that, Moody's stated that it expects pressure on the banking sector to persist as the Fed continues to hike interest rates to combat inflation. Okay, so I shared with you the story behind this collapse of right now 2 banks. However, I believe that there is always silver lining and lessons to learn from any challenge. So here's some of the lessons that you can learn from this bank's failure story. And these lessons will keep you safe with your money. Okay, so let's start. Lesson number 1, be mindful of interest rates trend. Many corporate clients, especially tech startups, are very sensitive to high cost of capital. Like what we have right now, right? We have rising interest rates, so the money is more expensive. And if you have a bank that loans money to startups, that's kind of a dangerous situation to be part of, right? When interest rates rise, long-term treasury bonds that this bank was investing in lose value, right? Therefore, make sure that you don't invest your cash in long-term bonds, in long-term treasury bonds that will lose value when interest rates are rising. Okay, very important lesson. Be mindful about trend of interest rates and how this trend affects your investments, because cost of money becomes more expensive. Okay, and by the way, if you have any questions, feel free to post them in the comments. I would be happy to answer. All right, let's move on to lesson number 2. Be careful with keeping all your money with regional banks. Okay, in general, probably just with any one bank, but specifically with regional banks. Why? It appears to me that larger national banks have more strict banking regulations and liquidity requirement than regional banks, right? Because these two banks were regional banks, and somehow they have more flexibility and not as regulated in terms of the insurance of their deposits from their customers. Okay, so that was lesson number 2. Be careful with keeping all your money with regional banks. Lesson number 3, make sure your cash deposits and banking products, like, for example, CD, certified deposits, are FDIC insured. So what is FDIC? FDIC is Federal Deposit Insurance Corporation, which guarantees safety of your bank deposits up to $250,000 per person or per banking product, like CD, for example. That's why people who have more than $250,000 in cash have accounts with different banks. Now, for some of you, it may not be relevant, but for some of you, it could be relevant. If you were saving money and you right now sitting on the side, not investing this, make sure that whatever savings you have at the banks, that they don't exceed $250,000 per your account, right? Now, not all financial institutions are insured by FDIC. Like, for example, credit unions do not offer FDIC insured. So always make sure that your money deposit is covered by the FDIC. Okay, even though right now President Biden said that we will cover, we will make whole every investor in Silicon Valley Bank. First of all, I don't think it's fair. I think when people take risk, they should be responsible for the risk they take, and not every taxpayer in the United States. But don't assume that it will always save you. Stay within FDIC coverage, right, for your deposit money. If your money is kept with an FDIC insured bank, you will at least be guaranteed to protect your principal up to $250,000. You will be guaranteed, okay? And that's what you want with your money deposits at the bank. So even if you have more at the same bank, you will at least get reimbursed up to this limit. Generally, there is no maximum amount that you can have on checking account, right? You can keep on the same checking account, whatever, 500, 300,000, whatever. However, there is a limit on how much of your checking account balance is covered or insured, insured by the FDIC. As of now, as I mentioned earlier, as of now, it's $250,000 per deposit, per financial product, per financial institution. All right. Okay, so moving on to lesson 4. Become financially savvy. I keep saying this again and again because it's so essential. It was always important, but in the challenging financial climate that we have right now, it's even more important. So consider alternative places to put your money to. Okay? While FDIC protection for cash deposits makes banks look appealing in difficult times like this one, I invite you to consider alternative places to put your money to. You may consider real estate investments that produce income, but you can also, this investment can be risky, as you know, right? So you can also invest in precious metals like gold, silver, platinum, which offer no income, but it's a great hedge. Another word for hedge is protection against devaluation of your fiat money, which we all experience right now in everywhere in the world, including the United States. And you can also invest in dividend-paying stocks, that established value stocks that pay consistent dividends. So what I'm sharing with you is how I diversify my investments, right? So if something happens with one investment, I'm not wiped out. So remember that nothing is guaranteed in this world, and nobody cares more about your money than you do. And it's your responsibility. It's your responsibility to be a savvy money manager of your money. You really need to know what you're doing, because as you can see, even some financial professionals are not competent as you would expect them to be. Okay, lesson number 5. Do risk return analysis. Okay, return analysis. While all investments involve risk, and I'm sure you realize that, some investments carry higher risk than others, and sometimes they provide higher return. But sometimes investments carry high risk and they provide low return. So when you invest, when you're about to invest, be very clear about the risk that you are willing and not willing to take, right? Diversify your investments across different assets to reduce your risk and to maximize your return. For example, remember that the assets that I will list right now are not insured. Assets like stocks, not FDIC insured. Bonds, not FDIC insured. ETFs, mutual funds, cryptocurrencies, life insurance policies, annuities, municipal securities, safe deposit boxes, including the content that you have there, right? So I hope these 5 lessons are useful. I hope that you will apply these lessons, because I can tell you that if you apply what you discover today, these lessons will save you from a lot of pain that many people experience right now. So that's all I have for today. I want to thank you very much for your attention, for your willingness to be good stewards of your money, for your support of this show. Let me know if this topic was helpful. I was hesitant even to bring this up because it's not very uplifting, right? But I always like to talk about something that is relevant, that is very important and hot right now, to help you become financially savvy so you keep more money with less stress and less risk. Again, you can download your gift, Beginner Investor Toolkit, at this link, giftfrommillen.com. If you want to learn how to invest strategically, because I believe that the only successful investing is strategic investing. And I hope you will join me for another empowering episode of the show next Wednesday at 10 o'clock Eastern Time. To your health, wealth, and freedom.